My name is Carly Hayden, and I lead our venture capital partnerships for our North America Startup Program here at Snowflake. I will be moderating our panel today on unlocking venture capital investment with technical advantage. Our goal for today is for you to walk away from this panel with practical insights on how to integrate your technical advantage into your pitches. I'm going to quickly run through our panelist intros so that they can help you guys better understand what sort of technical elements these VCs are actually listening for so you can better position your startups. Kicking things off with Tomasz Tunguz. Tomasz is a general partner at Theory Ventures, an early-stage software and infrastructure firm. Tomasz has worked with startups such as Looker, Omni, Monte Carlo, Lilt, Chorus AI, and Dremio. In addition to his work as an investor, Tomasz is also an active blogger at tomasztunguz.com. Next up, we have Pauline Yang, who is a partner at Altimeter Capital, a lifecycle investment firm. Pauline has led and worked on investments across the gaming and software industries, including Epic Games, Confluent, Unity, GitLab, and Ricardo. You may also know Pauline as the host of the artificial intelligence podcast, Cross-Validated, where she sits down with enterprise AI leaders to discuss trends and best practices in the industry. And last but not least, we have Philip Clark from Thrive Capital. Philip invests in software founders that are creating new markets in artificial intelligence, infrastructure, and security. Philip has worked with companies such as OpenAI, Physical Intelligence, Anduril, Wiz, and many that remain in stealth today. All right, guys, we're going to kick things off with a lightning round. So to help out our audience here, there's probably a number of different founders in the data and AI space. Would love to hear what are the key considerations when you are evaluating the technical elements of a startup for investment. Pauline, let's start with you.
Yeah, hey everyone, it's great to be here. I've been really focused on the last 2 years on AI startups, and I'd say I put them in sort of two categories. So one category is, are you training your own models? And the second category is, if you're not training your own models, you're building applications on top. There's different things that I look for. So if we start off with companies that are training their own models, I'm looking for what kind of architecture are you using? Is it transformer-based? Is it Hyena? Is it state space? Whatever it is. And most importantly, I think you're going to hear data as a very consensus theme throughout this is, what is your access to data? Are you using synthetic data? Are you using internet scrape data? Are you going out and creating the data? What does that look like? And then you can't talk about AI without talking about compute. And so if you're training your own models, are you using NVIDIA H100s? Are you using AMD? What is the underlying sort of component to train your models? And then in the second category of companies that are not training your own models, it really comes down to, again, data access. So if you're building in a very specific vertical, how are you getting that data to make your model better than just a traditional off-the-shelf model? What is the workflow that you're looking after? And so how are you getting really deep into a very specific domain and making it a lot better than, again, a traditional general off-the-shelf models? And so I'd say at a very high level, those are two categories that I think about from the technical side for AI startups.
Great. Tomasz, how about you go next?
Yeah, there are two things that we're really looking for when we look at AI companies. The first one is quality of revenue. So what do we mean by this? Well, in the world of AI, we've seen growth rates that we've never seen in software, right? It used to be maybe 5 or 10 years ago that a company that grew 1, 5, 15 was a pretty exceptional top quartile business. And you had a lot of confidence that if it hit that growth rate, that it'd be worth $500 million or more. And now what we're seeing within the world of AI is that there's a lot of fundamental shifts that are happening, whether it's at the infrastructure layer or buyer preferences are changing, or even the architectures themselves are changing. And so there's not the same level of confidence in the quality of revenue that exists within these companies. The second thing that we're looking for, going to Pauline's point about data, is particularly at the application layer. It's really rare for a startup to have access to proprietary data. We really don't see that. And so what we're looking for are workflows that generate proprietary data. So by using the software, the data set becomes more and more rich and more unique. And thereby, as it grows, its scale reinforces its moats.
Love it. And Philip?
Yeah, thanks, Carly. I think similar to what Pauline and Tom mentioned, we really view technical advantages in a startup as a way for our companies to break into new markets and then also to establish enduring moats once they're in those markets, really around data and distribution. And so we tend to see kind of three main areas in which that manifests. I think the first is how to use a technical edge to develop a new behavior with technical users. A great example, obviously, being OpenAI. It wasn't possible to build product architectures that could enable AI applications like that before LLM providers. The second big way is really, can you actually find a novel distribution strategy to get to scale quickly? Wiz is a company that we work with, and I think did a really excellent job with this by building out a agentless cloud security architecture that, despite there being a very crowded field of cloud security players, enabled them to get the distribution quickly, drive customer value quickly, and become dominant in the space. And then the third one is maybe the most fun one, which is how do you use technical advantages to define new atomic units of compute, which then can be used to get to new business models. And so Microsoft kind of pioneered that space with MS-DOS being the first horizontal operating system that you could monetize. But of course, I'd be remiss not to mention Snowflake, since we're standing here being the OG in pioneering consumption-based pricing with their separation of storage and compute. So it's really about how do you use these technical advantages to leapfrog your competitors and then build novel surface area with customers.
Cool. So a couple themes that I'm sensing here is building a sustainable foundational architecture, building in go-to-market efficiencies into that initial architecture, and then also planning for scale at the upfront. So let's dive a bit deeper into the technical advantages of these three categories for our audience when they're building, going to market, and scaling their startups. Alrighty, so Pauline, you were talking about the significance and importance of a foundational architecture. What early architectural decisions are crucial for success with AI and data startups?
Yeah, I think first and foremost, like if you think about the team, right? So do you have, particularly with AI startups, a group of AI researchers? What are they focused on? Do they have experience on the language side? Do they have experience on the video side? And again, goes back to the data piece. And so based on sort of the team that you're working with, are you outsourcing or are you building your own data curation pipeline, right? So I think one of the learnings that we've had in the last 6 months is really data quality is very, very important, more so than data quantity, right? And so if you think about the architecture, it's how are you building up this pipeline of data to make the best model that you possibly can? And then there's the basic, like, are you working on transformers or are you working on other things? And I'd say, in the transformers model, we've now seen just the scaling laws continue to hold if you're OpenAI or Anthropic or others. And so the question, if you're a startup, is can you get that level of capital that is needed to get the amount of GPUs that you need to train a similarly good model to be, competitive in the market? And so that's where I think we're seeing a lot of innovation on the architecture side, where they're saying, the transformer model isn't the most efficient architecture. And so is there a way to create a better model that's non-transformer based or beyond transformers? And so those are a few key components that I think about.
And I know that the capital management aspect of that is something we'll also get into a little bit later into this session. So Tomasz, you have worked as both a startup operator and investor. What are some common architectural challenges that startup founders face, and how can they overcome these challenges to build robust technical infrastructure?
I think the first question for any startup building with AI is, how much of an investment do you want to make in the technology? And so you can start by building a large language model, and that draws a really strong parallel to startups in the late 90s, where they would take half or 2/3 of the dollars they've raised to invest and buy servers. Today's equivalent is buying GPUs. That's one way of doing it. And what you're saying there is, we have enough confidence in our technical capabilities and our decisions in picking the architecture that we're willing to go and build in a basement, effectively, or a garage, for about 12 to 18 months, and that will be enough of a moat. And then you have the next level of fine tuning and then prompt engineering, where you say, I would rather get a startup basically declares into the market, I would rather spend the dollars in OpEx, the expensive venture capital dollars, as operating expense rather than capital expense. I would rather be in market sooner rather than later, get the customer feedback. And those are two very different technical architectures that require two very different capital fundraising strategies and two very different hiring plans.
Right. And I think that underlying all of this is the fact that every company today wants to be an open AI company. So Philip, how do you cut through that noise to determine which startups make the most sense to fund and work with?
Yeah. This is the $1 trillion question, so to speak. And I do think it's a good one because this paradigm shift feels a little bit different than ones we've had in the past, which is to say, I think if you were to look back at the successful businesses or startups of the past 10, 15 years, I would describe a lot of them as being market takers. They were businesses that use cloud native, more multiplayer, more ergonomic products to go against existing software companies and displace them as kind of a faster horse. But in this paradigm shift, we've gotten a technology shift with large language models without actually getting a distribution shift like we had with mobile or the internet. And so those incumbents with data and distribution are actually inherently advantaged here. And so what we're looking for as a result is, what are the startups that are market makers, that are taking behaviors or workflows that weren't previously possible to build with software and creating new AI solutions around that? And since that can be a little bit conceptual, I think, to make it tangible, these are companies that are usually pretty shocking in how new they are. I remember when I saw the OpenAI Codex demo for the first time in 2021, their original coding model, I was pretty floored it was even possible to build something like that. And then that feeling has been repeated a few times in the past 12, 18 months with products like ChatGPT, Cursor, Suno, 11 Labs, many others. And so I think what we're really often looking for are, what are these products that can create an almost new canvas where there's a shocking newness that entices and enthralls users?
Awesome. So once you all have your strong foundational architecture in place, the next step is going to be bringing those products to market. Let's pivot and explore some of the technical strategies for enhancing go-to-market efficiency. Philip, I'm going to come back to you. So you talked about a little bit about OpenAI, but you also work with a number of companies that are in stealth. So how can those companies be planning for their go-to-market strategy during the product development phase?
I think it's a great question because I do think that product and go-to-market need to be co-developed together. With the companies that I work with, we often talk about go-to-market being a product where the KPI is time to customer value. And I think there's often two pieces of that equation. There is the customer value piece, where a lot of what we plan for is, how do you build a go-to-market organization that reflects your customer and reflects empathy for your customer? And so, Figma famously had design advocates as a mainstay of marketing, or Vercel has lots of engineers working at sales team. And the second piece of that equation is that time to value piece, that minimizing friction piece. And there, I think a lot of what we try to focus on with our stealth companies and early stage companies is, how do you think about building a product whose onboarding motion feels really intuitive for your end user? A company I've really admired in their ability to do this is a company called Cursor, which is a next-gen IDE working in the AI coding space. And there, you can just do a one-click port from all your existing IDE VS Code plugins to a new coding environment. And so I think with all of these, it's really about baking the go-to-market into the product DNA and into the organization's people DNA.
Great. So looking at the go-to-market through a different lens, Pauline, as a crossover firm, Altimeter plays in both the public and private markets. Given your experience working with both early stage startups and hyperscalers, how are you advising startups to use incumbents as potential go-to-market entry points?
Yeah, so I'd reiterate a point that I think Philip made around the hyperscalers, that they have both the data, right? So companies, Fortune 500 companies, have their data sitting in S3 or Azure. And then you also need distribution, right? So these hyperscalers have massive number of customers. And I think there is a component where they can use their scale and leverage to their benefit. At the same time, I think we've seen very successful examples, Snowflake being one of them, as being able to both leverage the underlying sort of infrastructure that these hyperscalers have built, but also compete against them effectively, right? And so I think there is this component of these hyperscalers will have markets that they win because of their leverage and scale, but you can build a better product that's cheaper, better, and faster and really win against them. And so for, I think, early stage startups, it's finding that partnership or that unlock around that distribution with a potential, competitor, but also a potential partner, and figuring out like what is your mode and what is your ability to compete against them, and leveraging that. I think one example that we always like to point to, we helped, really partner with a very early stage company called Samua, which is a clean room company. And that actually, ended up getting sold to Snowflake. And that was a beautiful partnership that came from Snowflake-enabled Samua to cut down their go-to-market time, in that people already had data sitting in Snowflake, and they didn't want to sign another compliance and legal document, right, that would bring on more risk of copying that data elsewhere. And so that partnership between Samua and Snowflake allowed Samua to grow in a way that I think wouldn't have been able otherwise. And so I think finding that partnership, but also being aware of the pitfalls of, if you put all of your eggs in one basket, the hyperscalers may be able to sort of run you over. And so you have to be very careful with that. But I think finding that sort of magic balance could really unlock growth in revenue in a way that was really impossible before.
Great. And I think one category we haven't really dove into yet is the role of open source. So drawing from your experience working with startups like Hex and Dremio, how do you view the role of ecosystem partnerships in scaling leverage, and particularly that in relation to open source distribution?
For sure. Yeah. I think the really interesting part about the data ecosystem is no one solves an end-to-end problem, right? And so if you look at like data transformation, cloud data warehouse, transformation within the data warehouse, BI, or data analysis, you really need a bunch of different solutions. And that's why the data ecosystem is so partner-driven. Another big part to this is open source, right? So Dremio has an open source query engine, partnering with Snowflake on open source data catalog called Polaris. The great part about open source, particularly as data moves into a data engineering world, a lot of software engineers want to try the product before they ultimately buy. They want to test it. And open source is that freemium strategy for really technical audience. A really phenomenal go-to-market strategy. If you look, Gartner ran a study, and they discovered that cost of customer acquisition across publicly traded software companies has increased 60% over the last 5 years. And so for a startup or a company that's at scale, having any kind of material customer acquisition cost advantage is a compounding benefit. In Hex's case, they're a native application on Snowflake, and going to Pauline's point about partnering with hyperscalers, there are 3 core benefits to that go-to-market strategy. The first is Hex educates Snowflake AEs on the benefits of Hex plus Snowflake. The second, and so there's a lot of advantage just in terms of distribution. The second advantage there is that the sales process and the procurement process is much simpler. Hex doesn't need to go through security review. It doesn't need to go through procurement. It just uses Snowflake credits. And then the very last is there's actually a pretty significant gross margin contribution benefit to the business, because the infrastructure is now being paid for by the customer rather than by Hex. So, overall, and then Looker and Snowflake also had this experience in the early days where Looker partnered with Snowflake. And the reason that marriage or that partnership was so productive is a business analyst wanted an end-to-end solution to analyze data and then also have the super performant engine to crunch it. So this is a dominant design pattern in building great data businesses.
Fantastic. So hopefully you all have an idea on the technical strategies for building that foundational architecture, treating go-to-market as a product. But a third core principle here is, how are you building scale into your product from the beginning? So let's start with you, Tomasz. In your thought leadership, you talk a lot about the role of burn rate as a metric for both operators and investors alike. Can you provide the audience some long-term advice on how to think about burn in respect to potentially quite capital-intensive artificial intelligence companies?
Yeah, so the venture capital market has changed a lot, right? We used to have federal rates at effectively 0%. Now they're 5.5%. The cost to raise venture capital dollars in most sectors except for AI are exceptionally expensive. And efficiency has become a critical part of evaluating an investment, right? So it used to be growth at all costs 3 years ago. Today, you really want to burn multiple of about 1.5 to 2x, except in AI. In AI, the cost of capital is significantly less. It basically feels as if we're in 2021. And the advice there that I would give to founders is raise as much money as, and I know this is crazy, but raise as much money as you possibly can. And that's just because the capital intensity of these businesses is huge because of the GPU demands. The speed is really important. There's a moment in time where 5 percentage points of additional market share probably translates to pretty significant enterprise value creation 5 to 10 years from now, and to the benefit of compounding share. If you're perceived as a winner and you win 60% of the market, whereas if you're perceived as third place and you win 10% of the market, it's a massive difference in outcomes. And so that's why I think we're seeing both on the investor side, there's a lot of interest in AI, but because of the capital intensity of these companies, they're also raising significant sums to capture as much share as possible.
All right, so raise more money, guys. Philip, you touched on in our lightning round and a little bit in your other responses, the role of data gravity in creating moats. Can you talk about the long-term implications and the relationship of data gravity and security when building for that scale?
Yeah, for sure. It's a very interesting topic because data security has got hot recently as a topic for some reasons that I can talk about. But really, I view it as very foundational in cybersecurity because if you think about it, all security breaches at the end of the day are essentially data breaches. What attackers want are your data. And the reason why this, I think, has become a lot hotter of a topic recently is you rewound the clock 10, 15 years to the pre-cloud days. You had a castle and moat architecture where all of your sensitive data lived on-prem in your servers. And as long as you protected the corporate network, you were safe. But with great power comes great responsibility, and you've got the modern data stack. And now data is distributed across many different data stores from Snowflake to Airtable. And it's also being consumed by lots of third-party services. And most recently, the big one here are large language models. And so as a result, I really think that data security, in order to build data gravity, has to be a first-class citizen of the product experience, because otherwise you're going to run into a situation that we're finding a lot of large enterprises are encountering right now, where they're hesitant to add new product functionality, particularly around AI, because they're worried about the data security implications of that. Now, I think the good news is that these are solvable problems, and really what you need are tools that can identify where sensitive data lives in your organization, and then tools where you can actually control the flow of sensitive data across your product and organization. And we've been privileged enough to work with a handful of companies that are tackling those, but definitely not something that's going to be top of mind in the AI era, in our view.
Great. So I know that we're close to wrapping things up. So to close, Pauline, you've worked with a number of startups across the life cycle. What sort of factors do you look out for as key indicators of potential viable exit strategies for these startups?
Yeah, I think right now we're seeing this dynamic of, there's a lot of companies that want to go public or feel like they've gotten to 100, 200, 300 million of revenue or ARR that are, want to go public or are getting ready to go public. But the reality is, I think there's a lot of, subscale public companies right now, particularly in software. And so, the sort of soft circle number that people sort of think about is like, really you need to be in the 300 to 500 million of revenue range for you to really capture attention of analysts and mutual funds and hedge funds when you're in the public markets. And so I think there is a component, if you're building a startup, earlier, is how do you think about the TAM of your market? How are you going to get to that scale of revenue? And certainly, Rome wasn't built in a day. And so there are companies like Perplexity that are going after Google's market, which is massive search market, and others that are starting off with more, smaller wedges. Snowflake really started off as a data warehouse company before expanding to become a full data cloud platform, right? So you can build your markets and how you win over time, but sort of having a strategy as to what is that path for you to get to 500 million of revenue in a reasonable period of time, I think something that has become even more important today than it's ever been for, a fully independent, exitable company.
Great. I will admit freely that I don't know how much time we have left, so I was curious if we have time for Q&A. We do? Great. Any questions from the audience on, how you guys could be better positioning your own technical advantage in your pitches?
At the beginning of the talk, you talked about quality of revenue as being a very important factor. Can you add a little bit more detail about what factors you see as making revenue high or low quality?
Were you able to hear that?
Yeah,
Okay.
I think I heard the question. So you said at the beginning of the talk, I spoke about quality of revenue. Can you provide some indicators about how you would gauge the quality of revenue? I think that's the question. And the answer is we're still working on it, right? I think it used to be net dollar retention, right? Like you had the ARR, you had bookings, and all of a sudden you'd see like Snowflake 100, 220 at the beginning, down to 171. Net dollar retention, quality of revenue was really high. And the combination of net dollar retention plus gross retention, north of 90%, you had a really phenomenal business, right? I think what's really hard now is with AI, you have these massive bookings, you have lots of people that are interested. If you're a leader within a company, the pressure that you face from your manager, whether it's the CEO or the board, is you need an AI strategy. And it's really easy to have an AI strategy that's a single product. I can use this as security for AI. I can use this for marketing for AI. And so you have lots of people who are trialing the products, but it's unclear whether or not they'll stay. I think the easy answer or the most straightforward answer would be multi-year deals. If a company is willing to sign a multi-year contract, probably pretty good quality of revenue. The reality is when you're an early stage company, the odds that you're signing multi-year TCV, the total contract value deals, is very, very small unless you're in particular categories. So I don't have a great answer for you today. We're working on it. We're working on answering that question.
Awesome. And then can you state your name and who the question is for, just so that we can...
Oh, hi, I'm Eric. I have just a general question. I just want to hear general perspectives. I feel that in the field of AI, there's been a lot of huge shifts with changes in architecture, and previous generation, for example, startups that have built on, for example, RNNs feel very displaced by the new emphasis on transformers. I'm curious how you venture capitalists think about investing in these startups that are emphasizing their foundation models, and what happens when OpenAI, for example, might produce the next, when you release, for example, ChatGPT 5, and if that takes away or kind of clears the field for startups. I'm just curious what you guys think. Thank you.
Give a quick lightning response to this because I know we have to wrap it up.
Yeah,
Pauline,
I'm happy to go. It's a question we think about a lot, and obviously Thrive is a meaningful investor in OpenAI. Our framework has been, how do you try to align yourself such that you are riding the compounding wave versus putting yourself in the crosshairs? And I think OpenAI very much wants to be a platform company. And really, I think the leadership team there has made themselves pretty clear, which is as long as you're not building the world's best personal assistant and you're not something that is on the critical path to AGI, they want to be an enabler, not a competitor to you. And so whenever we think about working with companies, it's how do you think about a 10x increase in model capabilities being a 10x increase in product quality for that company working with versus something that might actually erode their core moat or product advantage. And as long as we can get comfortable with that, this is an area where I think companies like OpenAI can be a real ally versus something more of an inhibitor.
Awesome. Well, thank you, everyone. Hopefully you took something away on technical advantage for product development, go to market, and scale. And let's go build some great companies. Enjoy the rest of Dev Day. Thank you, guys.